For 10 years, you did everything right. You saved, you diversified, you trusted the system, and yet your purchasing power is smaller than when you started. This isn't bad luck, and it isn't incompetence. It's the default outcome of a system designed to reward issuers and punish savers. If that sentence makes you uncomfortable, good. It means you're starting to see what most investors never do. Why almost all of them lose without ever realizing it. The numbers you see in your banking application are designed to provide a sense of security, but this is an illusion. They represent a nominal value, a unit of account, but they do not represent stable purchasing power. While the balance on the screen remains unchanged, the underlying economic energy of your capital is being siphoned away through monetary expansion. This process is silent. It is continuous. It is the default setting of the fiat system, an architecture engineered to transfer wealth from savers to debtors and to the state. The absence of visible activity on your statement is not safety. It is the quiet, methodical execution of a wealth redistribution protocol that is actively working against you. The greatest financial risk you face is not a dramatic market crash or a televised bank failure. It is the slow, methodical erosion of your capital, disguised as stability. This risk manifests as low-yield savings accounts, standard management fees, and the conventional financial products that promise security. These instruments are not broken. They are working as intended. They are designed to underperform the true rate of monetary inflation and real asset appreciation. By the time the average person recognizes the significant loss of their purchasing power, a decade or more has already been irretrievably lost. The normal financial environment you have been taught to trust is, by its very design, a system of guaranteed long-term loss. The logic is simple, and it is unforgiving. If your capital's rate of return is lower than the combined rate of currency debasement and real asset inflation, you are not preserving wealth. You are actively losing it. To stand still in nominal terms is to move backward in economic terms. Your capital is dying. This is not a market opinion or a forecast. It is a mathematical certainty. The critical metric for your survival is not the nominal interest you have earned. The only metric that matters is the change in your ability to acquire scarce assets over time. Most conventional financial strategies fail this fundamental test, ensuring a net loss of your economic power. In the year 2026, the primary question is not about your interest rate. The only question is, who controls the rules of the monetary system? When central institutions have the authority to expand the money supply at will, to alter regulations without consent, and to dictate the terms of access to your own capital, passively holding their currency is an act of outsourcing your financial future. You are consenting to have your future purchasing power determined by a committee whose incentives are not and cannot be aligned with yours. This is not a flaw in the system. It is the system itself. The critical error is waiting for an explicit crisis, a sovereign default, a hyperinflationary event, a collapse that leads the evening news. The most significant losses are not event-driven, they are time-driven. They occur quietly, day by day, through the persistent debasement of the currency. You do not lose your capital in a single moment of panic. You lose it over the course of a decade of complacency. By the time this reality becomes undeniable, the correct sense of urgency finally emerges, but it is accompanied by a dreadful question. What if the window of opportunity to act has already closed? Lost time is the one asset that can never be recovered. At this point, the decision you face transcends portfolio allocation. It becomes a choice of financial architecture. You can either hold an instrument that is systematically and perpetually debased by its issuer, or you can seek an instrument that is engineered to be immune to such debasement. If such an alternative exists, the choice becomes binary. You are either in a system of centralized control and guaranteed value erosion, or you are in a system of decentralized, verifiable scarcity. There is no neutral ground between these two architectures. You must choose one. I am not talking about theft, default, or bankruptcy as a singular event. I am describing debasement as an engineered feature of the monetary system. It is a persistent tax on your capital that you pay without consent. This process is designed to be nearly imperceptible in the short term, which is precisely why most people recognize its devastating effect only after years or decades of accumulated losses. It is a silent, continuous transfer of economic energy, and your passive participation is all that is required for you to be on the losing side of the transaction. When interest rates fall towards zero and the cost of capital is compressed, it is presented as a technical monetary policy adjustment. It is not. It is a fundamental alteration of property rights, heavily skewed in favor of the currency issuer and against the holder. You are now operating within a system where passivity, holding the currency, is a mathematically guaranteed loss over time. The rules have been rewritten to make saving in the base layer of the economy an irrational act, forcing you to take on greater risks for diminishing returns. The most dangerous reaction to this environment is the one that feels psychologically safest. Buying more reliable assets, averaging down on failing strategies, and clinging to the familiar model. This behavior is often mistaken for financial discipline. In reality, it is a critical error that results in the loss of your most finite and valuable resource: time. While you are busy reinforcing a failing position, the underlying economic realities are accelerating against you, making your eventual pivot more costly and less effective. The comfort of the familiar is a direct trade-off for future solvency. As the yield on capital approaches zero, the very definition of savings is inverted. Saving is no longer a neutral act of preserving purchasing power for the future. It becomes an explicit bet on the continued stability and fairness of the monetary system's administrators. History provides extensive evidence that when faced with a choice, issuers and regulators will act to preserve the system at the expense of the individual saver. This historical reality should provoke a critical question. Am I participating in a game that is structurally designed for me to lose? The threat then intensifies with the addition of a regulatory layer. A new form of property is first ignored, then actively restricted, and finally, regulators attempt to integrate it in a way that neutralizes its threat to the incumbent system. If you perceive this as a debate about technology, you have misunderstood the fundamental conflict. This is a battle to preserve a legacy power structure. The technology is merely the catalyst forcing the confrontation. The core issue is, and always has been, control over the rules of money. The decisive conflict will not be technological, it will be regulatory. The battleground will be defined by permissions, access, infrastructure, and the rules governing on-ramps and off-ramps. This means your primary risk is not merely market volatility, but the volatility of the legal regime itself. Regulatory risk can manifest suddenly and without warning, instantly changing the viability of your strategy and the security of your assets. It is an asymmetric risk controlled by the very incumbents the new technology seeks to circumvent. To a novice, this sounds like a forecast of doom. To a professional, it is a simple analysis of mechanics. Any distinct advantage offered by a new asset will inevitably face two outcomes. It will be legitimized and integrated at scale, or it will be contained, restricted, and burdened with prohibitive cost and friction. If you wait for a state of complete regulatory comfort and clarity, you are by definition choosing to be late. You are waiting for the moment when the opportunity has been minimized or legislated out of existence. This is why time becomes both your greatest asset and your most critical vulnerability. While you are engaged in years of due diligence, the rules of the system are being finalized. Access that is open today can be restricted tomorrow. Infrastructure available now can be closed to unprepared participants. This is the source of rational panic. The realization that the optimal window for action was in 2026, not 2028, and that you spent that critical period observing instead of acting. Therefore, the strategic decision reduces to a simple reality check. Can you build your financial life on the assumption that the currency issuer and the regulator will always act in your best interest? If the answer is no, then you logically require an asset where the rules of ownership are defined by an immutable protocol, not by a committee of fallible individuals. You need a system where you accept the inherent volatility as the price for escaping the certainty of debasement and regulatory capture. This is the intellectual turning point. You stop evaluating assets with the outdated labels of reliable versus risky. You begin to assess them based on a single dispositive criterion: who controls the rules? If you understand this criterion today, you are still positioned to act. If you postpone this understanding, you are already paying for the delay with your time, your most non-recoverable asset. At a certain point, the choice is no longer about a quote-unquote portfolio. A portfolio is a luxury afforded by a stable monetary system. When the cost of capital approaches zero, the conversation shifts from asset allocation to capital survival. It is no longer about optimizing returns. It is about making a foundational decision to preserve economic energy. This is not an investment choice. It is an engineering choice about the architecture of your wealth. You are no longer managing a collection of assets. You are selecting the base layer upon which all future value will be built. This must be stated directly. You have three paths: a fast economic death through leverage on depreciating assets, a slow economic death through holding debasing currency, or movement and risk. A zero cost of capital is an unambiguous signal that to remain static is to consent to a slow, guaranteed degradation of your purchasing power over time. Inaction is not a neutral stance. It is an active choice for the path of certain, though gradual, loss. The only logical alternative is to embrace the volatility inherent in a viable solution. The analysis of alternatives reveals a common critical error: borrowing short-term, expensive money to acquire assets that are themselves being debased. This is not a trading mistake. It is a fundamental flaw in the capital structure. It is an architectural problem that guarantees failure under stress. This strategy is fatally exposed when market conditions turn and maneuverability is gone. You are financing a depreciating asset with an appreciating liability, a structure that is mathematically destined to collapse. This is the precise mechanism by which both companies and private investors are destroyed. Their liabilities compound on a predictable schedule, while the value of their assets can decline without one. A strategy that relies on the financial system remaining stable and benevolent is not a strategy. It is a request for favorable treatment. You are depending on the goodwill of creditors and the predictability of markets, which is a position of extreme fragility, not a robust plan for capital preservation. The most rapid form of failure is the compromise approach. A compromise, such as a small token allocation, creates strategic ambiguity. This ambiguity invites external interpretation and ultimately external control. It signals a lack of conviction, which allows creditors, markets, and regulators to dictate terms. Your partially committed capital is not truly under your command. It becomes an object to be managed by outside forces. A compromise strategy is an invitation for others to define the terms of your eventual failure. Therefore, a clear principle is necessary. The strategy must be simple, verifiable, and must not require trust in the benevolence of the system. If your asset's ownership is defined by the rules of its issuer, you must operate under the assumption that, in a crisis, the issuer will change the rules to their own benefit. This is the single point of failure that most participants ignore until it is too late. Your strategy must be founded on a protocol, not on a promise. At this point, reality becomes binary. This is uncomfortable, but it is honest. A 0% allocation to Bitcoin is an explicit choice to remain in the legacy game and accept its guaranteed slow degradation. A 100% allocation is an explicit choice to accept volatility as the price of absolute ownership and as the fee for exiting a system of issuer subservience. There is no intellectually consistent middle ground. You are either subject to the issuer's rules or you are not. A novice hears 100% and thinks of gambling because they only see the price chart. This is a surface-level analysis. A professional must hear 100% and think of systemic risk elimination. The primary risk is not price volatility. The primary risk is that the rules of ownership and the cost of capital will be rewritten against you by a central authority. The 100% allocation is the logical engineering solution to that specific non-negotiable risk. This is the origin of true panic and logical fear of missing out. The fear is not, what if I did not buy at the best price? The real, more potent fear is, what if I spent years on convenient excuses instead of making one clear decision? The cost of that error is measured in time, and time cannot be repurchased at any price. This realization is the final, powerful catalyst for action, but it often arrives after the most opportune moment has already passed. I have made a decision. It was not a partial allocation or a move made for quote-unquote balance. The language of balance and diversification belongs to those who still operate under the flawed assumption that the rules of the legacy financial game will remain stable and that the cost of money is honest. This assumption is demonstrably false. Therefore, my action was not a portfolio adjustment. It was a complete architectural shift from a failing system to a viable one. This is not about balancing risk. It is about eliminating a certainty, the certainty of debasement. I selected Bitcoin as digital capital for a single specific reason. I require an asset that is immune to dilution, confiscation, or redefinition by administrative decree. Any asset that can be debased by an issuer will be debased. This is not a cynical opinion. It is a predictable outcome of political and debt-based monetary systems. The incentives are permanently aligned in favor of expansion. Bitcoin's protocol removes this possibility, making it the only logical destination for long-term capital preservation. It is an engineering solution to a political problem. The logic that follows is straightforward and applies to everyone. Capital either preserves purchasing power over time or it loses it. There is no third state. If you do not control the issuance schedule and the fundamental rules of the monetary network, you do not control the outcome for your capital. You are, by definition, a passenger. You are accepting the uncompensated risk that your time and economic energy will be diluted without your consent, a risk that history shows will always be realized. Therefore, my operational structure is extremely simple. I convert liquid capital into Bitcoin as it becomes available. Any other action is an attempt to argue with mathematics and the relentless passage of time. Capital that has not been converted into a verifiably scarce form of property is by default subject to a quiet and continuous subtraction of its value. Holding fiat currency is not a neutral position. It is an active, short position against a superior monetary technology. I have adopted another core principle. I am not engineering a path back to the old system. A return to that environment means resubmitting to the slow, methodical confiscation of capital through inflation, devaluation, transaction fees, arbitrary prohibitions, withdrawal limits, and so-called temporary emergency measures that inevitably become permanent features of the system. To re-enter is to concede that a system of guaranteed loss is preferable to the volatility of a solution. The fundamental outcome will be the same for every market participant, and it is approaching faster than most are comfortable admitting. You either transition your capital to a digital, protocol-based system, or you remain in a centrally managed system where your capital is guaranteed to lose its power over time. If you defer this decision, you have still made a choice. You have chosen inertia and its predictable consequences. In this environment, inaction is the most aggressive form of risk-taking. The consequences of this transition will scale, not because everyone suddenly understands the ideology, but because capital is relentlessly logical. It flows towards survival and advantage. When a demonstrably superior vehicle for storing value becomes available, capital does not migrate there for philosophical reasons. It migrates out of economic necessity. It is a rational response to a broken environment. The mass adoption of a superior technology is always driven by utility, not by consensus or persuasion. The next logical step is disruptive to the legacy financial world. Bitcoin as a capital asset gives rise to Bitcoin-denominated credit. Once a credit market emerges that is collateralized by a stronger, more transparent, and auditable asset, the credit instruments of the 20th century, which are built on promises, opacity, and the ability to debase the underlying collateral, will begin to lose the competition for capital. A superior collateral layer will inevitably support a superior credit system. I do not promise comfort, because comfort is the price paid for procrastination, a bill that comes due later with interest. I am simply fixing the point of no return. For me, there is only one logical choice, and it has been made: 100% BTC or 0%. There is no intellectually consistent middle ground. If this binary reality creates a sense of urgency or anxiety, that is a productive signal. It means you understand that the time for a decision has arrived.